Hey folks, welcome back to the channel. It looks like the stock market has finally pulled back. If we take a look at the weekly chart, we can see it was getting way overextended, and usually when that happens in the past, the market makes a correction. However, if I go back to the daily chart, even though this is a pretty big move, almost 3% in just a few days, if we draw a channel like this over the last few months, you can see it's still within the uptrend. So a major point is going to be over here at the bottom of the channel, and we'll see if this support area will hold and we get a bounce here, or if it just falls right through. If it goes up, then most likely the uptrend will continue, but if it goes below, and especially if it does a back test and fails to go back into the channel, then that is when the bears will take over. There are lots of reasons why the market went down this last week, but one reason is the economy is looking weaker. The unemployment rate in the US rose up to 4.1%, which doesn't seem like a very high number, but if we go to a 5-year trend, we can see that it's now above the pre-pandemic levels where it was at 3.5. And of course, over the last year, the trend is going upwards. So we're probably going to get rate cuts pretty soon in the US, if not this month, then almost guaranteed in the next meeting in September. And it's not only in the US that policymakers are considering to lower interest rates, because if we look at central banks around the world, in the most recent months, we've had so many interest rate cuts in different countries. There's Canada last month with a 0.25% decrease. And speaking of Canada, the next interest rate announcement is for this upcoming week on Wednesday, July 24th. And I think they're going to cut rates again by 0.25 because our economy seems to be worse than the US. Here we can see the unemployment rate for Canada, and the rate didn't just grow a little bit, but it jumped to 6.4% last month. And again, taking a look at the 5-year chart, this is not a good trend. And the rate is also higher than when the last recession began in 2020. So it's not a surprise that central banks around the world are trying to get in front of these recessionary pressures and cut rates before their economy goes down. Earlier in the year, I made a video saying the recession is probably going to come this year, and it will most likely come in the fall, so September or October, around that time. And so far, it does look like that's going to be the case because this chart, which shows the number of people who are long-term unemployed, is highly correlated with recessions in the past, and its signals have been 100% accurate over the last 70-something years. So since the earliest point of this data, in 1948 until now, there has been 12 recessions in the US, which are indicated by these gray bars. And in chronological order from left to right, you can see that whenever the number of unemployed over 26 weeks, or basically people who are out of a job for 6 months but are continuing to look, when this number moves higher on a monthly basis, it coincides with a recessionary period. So here in 1949, that's what happened. 1953, you see a spike up in this number, and that was correlated with a recession over here as well. And if I just scroll to the right, you can see every single time, especially during a long period when this rate is slowly trending down, whenever you have a change in that direction and an increase in the slope, boom, recession. And what's interesting is that most of the time, the start of the recession happens before the slope is steepened. So recession, recession, recession. Also over here in 2001, and then more recently, we have the 2008 recession, and this recession happened just before the long-term unemployed rate started to go up very fast. And finally, the most recent recession was very short-lived in 2020. That also coincided with a steep increase in this rate, but the recession was so short, it was over before the rate even started to go up. And that basically takes us to today. And if I shorten this a little bit so we can more clearly see the month-to-month change, and we have this year's March, and then April was a little bit higher, and then May was a bigger increase in the previous month, and then finally June is an even bigger increase, so that is why the slope is steepening. And I think at this point, looking at the slope, it is looking very much like all the previous slopes in history, where recessions also happened. So in terms of recessionary indicators go, I mean, this one nailed it 12 out of 12 times. So I think that's pretty reliable. Of course, there's no guarantees. We could see this blue line actually reverse and head down over the next couple of months. It could happen, but what's more likely to happen, I think, is that this line will continue to go up at an increasing rate, which historically speaking should signal either the US has already started to go into a recession or it's about to. And when that happens, I don't see interest rates going anywhere but down. Another indication that a recession is imminent comes from this tweet by economist David Rosenberg, and he shares this chart which shows how healthy the manufacturing sector is. Basically, a reading above 50 is expansionary and below 50 indicates contraction in manufacturing. And his point is that the newest PMI came in at 35.4, and similar to the long-term unemployed chart we just looked at, this goes back decades, and every time it has fallen to this level, 35.4, the US falls into a recession. And with a high chance of a recession coming up, corporations will likely earn less money. So there's probably a lot of investors who decided to sell at this time and take some profits. Because at least over the last year, since July of 2023, the market has gone up about 30%, which is quite a lot for an index. But whether it'll continue to go up for now will again depend on this key level over here, and we'll have to see what the market does in that zone. Now, in the upcoming month, we will get the GDP number for Q2. And if that is negative, then that could be the start of the recession, which by definition is 2 quarters of contracting GDP. So in Canada, our latest GDP reading is 0.4 for Q1. Sometime next month, we'll get the reading for Q2, and we'll see what the economy looked like in the last few months. But I have a feeling it's not going to be very good because economies are slowing down all around the world. The second biggest economy, China, already came out with their second quarter GDP data, and it was weaker than expected. And we're all connected in the global economy. So in conclusion, economic activity is slowing down around the world, and central banks all over are cutting rates. And I don't think Canada or the US is an outlier. So we're going to see more rate cuts here, and the US is probably going to start cutting rates soon as well. And this will likely be the start of a big rate cutting cycle that's going to last many years. And usually when that happens at the start of a rate cutting session, the stock market does tend to pull back, which is what we're seeing. But because the US hasn't cut rates yet, and they might wait until September to do so, this short-term correction may be temporary, and we could see higher prices in the stock market in the weeks to come. So keep an open mind on that. I would not be bearish in the stock market until I see a break of this channel followed by some kind of confirmation or follow through. Because right now, the trend, if you just look at it broadly, is still going up. And people who think that this is definitely the top of the market right now are probably the same people who thought that back here in January, that this was the top just because we had 1 week when the stock market went down. But if they went short here, they probably lost a lot of money on this big leg moving up. So that's why I say keep an open mind for now. But anyway, that's it for this time. Thanks a lot for watching. Good luck with your investments, and until next time.